Greetings, judges and members of the board. We are here today to discuss a strong and intelligent risk management framework, which we believe can safeguard BAML's margins from extreme volatility in the global market based on the data that was provided to us and for the data that we are going to produce here. Now, let's take a look at the executive summary. The EBITDA margin compression experienced by BAML in recent year has been from 14.2% to about 11.6%. To address this, we are implementing three strategies. From a commodity perspective, we are using an analytic hierarchy process, or the AHP, that is very frequently used in scientific studies, to allocate our hedges in the proportion of 75% for iron ore and 50% for coal. Financially, we will be putting in place a structural trade netting and implementing an interest rate swap. In the end, this yields a profit of about 11.4%, which is still better than 10.74% under a catastrophic market shock. It is essential to have an understanding of our baseline. So our revenue is about Indian rupees 18,500 crore, out of which 55% of our production costs, they are from raw materials. So the recent geopolitical issues and port delays in Brazil were a catalyst. We were forced to hold our working capital as well as our inventory up to an inefficient, that is 71 average days of inventory days compared to 48 days. The need to rely 100% on spot procurement is no longer feasible. So for the risk architecture, to build a defense, we took a scientific approach to prioritizing our exposures. So 1.2 million tons of annual exposure and vulnerability to supply shocks for iron ore gives this exposure a 54% weight. For foreign exchange and interest rate risks, we assigned a risk weight of about 30%, and which are primarily characterized by heavy structural mismatches and floating loan worth, that is 150 million US dollars. For coking coal, the weight assigned is around 16%. Which has been threatened by a single source dependency on Indonesia. Now we translate these weights into action by creating our hedging matrix, as is displayed in the Excel sheet that we have submitted with this video. In the case of iron ore, we are aiming for a 75% hedge ratio on a rolling basis for 0 to 6 month period with the Singapore Exchange Futures market and an OTC forward market. So we aim for 50% of coal, 50% hedging ratio for the coal through customized over-the-counter forwards for reducing basis risk. We are also introducing very strong governance, which is very important. For treasury, hedges are triggered by mechanical events, and we remove the emotional constraints completely. So as soon as iron ore hits $125 per ton, it will execute the hedge. Our physical sourcing mix is 50% long-term structural contracts with Australian and Brazilian miners, with the volume average price per month being smooth. 30% medium-term forwards to diversify into South Africa, and 20% dynamic spot sourcing to take advantage in case there is backwardation in the market and to be agile.
Trade netting. Speaking of financial risk, our first step should be to maximize natural hedging. BAML has $620 million of export and $480 million of import obligation. We will have no double conversion bank spread over this $480 million, which we will hedge for using layer currency forwards up to 6 months. Interest rate swaps. To offset the floating debt, we entered interest rate swaps with floating rates from an institutional counterparty. This exactly mitigates the floating charges from the lending bank, which leaves BAML with fixed rates from a counterparty through 2030. Resolving the Nigeria crisis. We are entirely avoiding Nigerian currency volatility and dollar shortage by capital inversion in supply chain for our Nigerian work. Our hubs in India and Vietnam will issue semi-finished components on intercompany credit line of 180 days. Moreover, we will receive surplus Naira from the domestic MNC and settle their parent companies abroad using our Naira trade surplus of $140 million. Treasury KPIs. To maintain continuity of compliance, Treasury will be monitored and reported against stringent KPIs. The hedge ratio coverage of the inventory will be kept at 70 to 80% of a rolling 90-day period. EBITDA variance will be within plus or minus 2% of the target, and the cash flow at risk will be kept at a tight level of less than 5% of our liquid reserves. Scenario analysis baseline. Now, let's stress test this framework. Let us see the impact of iron ore price hike of 15%, a rupee devaluation to 88, and freight escalation by 20% on the unhedged EBITDA of business, which comes down to 1,987 crores or 10.74% margins without any protection. Mitigation and EBITDA defensibility. Here's the financial proof of our strategy. On the waterfall chart, you will see how the unhedged stock has pushed our profit down. But with our 75% iron ore hedge, we're able to recover 134.8 crore. With a trade netting gain, we end up at a comfortable 2,122 crore and an overall margin drop of just 0.13%.
In addition to risk management, we discover active value. This will be done by adopting better contrasting practices by combining gaps and the flows with the suppliers and the material cost. Escalations clauses with the customers, in practice establishing a just-in-time buffer approach to reducing inventory to 48 inventory days automatically frees up tied up working capital and put less pressure on our users of costly short-term financing. Finally, we are transitioning Treasury into data-driven powerhouse. Beyond eliminating execution silos, we are deploying automated Python and R scripted. We can automate this process rather than standard sum models. We can achieve high accuracy forecasting of logistical bottlenecks and port disruptions week in advance, allowing BAML to work on the supply chain before the market reacts. This is highly actionable today. In the first 3 months, we secure board risk sign-off and establishing clearing accounts. By this month 6, we launch the multiple currency account and execute the IRS. Month 7 to 9, focus on optimization, renegotiating collars and opening the Nigeria credit lines. By the month 12, our predictive analysis dashboard goes live, culminating in our inaugural compliances report to the board.
By prioritizing data, integrating our tools, and enforcing strict governance, BAML will master its market. Thank you so much for your time.